Welcome, everyone, to Advantaged, a High Alpha Innovation podcast. I'm Drew Beechler, our VP of Marketing here at High Alpha Innovation, and your host of Advantage today. And if you're unfamiliar, High Alpha Innovation is a venture builder. We partner with some of the world's leading organizations and amazing entrepreneurs to co-create Advantage startups together. And this episode is part of our 2025 Innovation Trends mini-series podcast. We've taken, the last few weeks to interview a number of our team members on trends on their mind and where they think things are heading in the new year. And so today with me, we have our Director of Portfolio Success, Nate Schmidt. Thank you, Nate, for hanging out with us. We're both here in Indianapolis. I'm based in Indianapolis. Nate came up from Birmingham last night, which is great. And Nate is a multi-time founder, founded the first accelerator in Alabama, former MD at Techstars for a number of years, an avid mentor and advisor for countless startup and CEOs and founders and entrepreneurs. And I think now has one of the coolest roles on our team here at High Alpha Innovation. He works every single day working hand in hand with our founders to help make them successful. I like to think, I was saying this earlier today, I like to think of him as our CEO whisperer, the guy that someone calls at, hopefully not at midnight in the middle of the night, the guy that they call when their hair's on fire or something's kind of blowing up, or the good things, hopefully too. But Nate's just an expert in many, many things related to startups, entrepreneurship. But one thing in particular, Nate, that is we were kind of talking about topics to discuss and something just top of mind for every entrepreneur and for founders, especially kind of heading into this new year, and something that you spend an incredible amount of time on with our founders is fundraising. So I thought, what better way to kick off some of our conversations around this, and what better person to have on the podcast to talk about some of the startup fundraising climate, how you're advising our founders and other founders. I just thought it'd make for a really great conversation. Most of these, just to set a little bit of context too, most of the episodes we've done to date have centered a little more on corporate innovation, corporate strategy, kind of startup engagement from the perspective of a large corporation. But this episode, we're really going to focus more on the startups and the founder perspective, and particularly through the lens of fundraising. So there's a lot here we're going to unpack. It's going to be a ton of fun. And a lot of this is opining probably on things that, it's the wild, wild west, and none of us can really be true of like what's going to happen, in the future. But maybe just to ground us a little bit, Nate, why is fundraising important for a startup in general? Why is it important for the ecosystem? Why are founders raising capital? Why are we having this discussion? Just even in the first place, maybe start there.
Yeah, look, it's an honor to be here. I appreciate you inviting me onto the pod. I find it interesting that you think my job here is such a great job. The grass is always greener somewhere else. So I think your job's pretty cool. But no, you're right. I get to work with founders every day. CEO whisperer, I'll take it. They really do call in the middle of the night sometimes. And working with founders at the earliest of stages is a blast. And look, fundraising is a piece of the puzzle, no doubt about it. And it's awful. Like, fundraising is not fun. I would go so far to say as fundraising sucks. When any of us decide to go do a new company, and I'm a 5-time founder myself, you don't think on day number one, like, hey, I'm going to go raise some money. You want to go operate the business. You want to work on the business. And so finding out that you have to spend a lot of your time fundraising is sometimes a real surprise to first-time founders. And, there's a few reasons that you raise money, and they're all valid. One is you cannot start the company without it. So if you have a great idea and you can't take the risk of no salary and whatever else that comes with starting that company, you can go out to investors. You can go out to market before you've done anything. And you can say, hey, I've got this idea, and if you'll fund it, I will do it. And things like accelerators really fill a gap like that one. There are many times where the initial $100,000 or so that you get from a top-tier accelerator allows you to start a company, which I've been a part of that, both as a participant in Techstars and then a managing director of Techstars. This kind of the second layer is what Paul Graham would call default dead. You're going to die if you don't go raise more money. The company is running. Maybe it has customers. Maybe it has revenue. It's definitely burning money. But you're not going to get to profitability before you run out of money. So most startups are in this category, and it's a perfectly reasonable place to be. Then the final category is, and this is the best one to be in, you don't really need the money, but you have such great progress happening that the market's throwing money at you. This is fantastic if your company gets here. It means you're probably headed toward a big exit. And this is kind of a spot where founders might even take some chips off the table. So understanding where you're at. Are you raising from a position of strength? Are you raising from a position of weakness? Where you're at on that continuum, I think, is really important. But either way, fundraising isn't very fun. And the more prepared you are for it, the better chance you're going to have at success. And I'm sure we'll talk about some of that preparedness today.
It's a great segue into Let's take a step back even and kind of just talk about fundraising 101 for a second. So I've heard you say this before. I love the line specifically, but many startups, many founders, they think they're fundraising and you would say they're really not. And I think you have a pretty strong perspective and point of view on kind of the right and the wrong way to fundraise. And so maybe just let's start the broader conversation there with just kind of what's a quick fundraising 101 almost from your point of view on kind of the right way to fundraise and how founders should be kind of thinking about it from first principles almost.
Yeah, I've helped a lot of startups fundraise, and maybe $500 million in fundraising have come from founders that I've directly worked with and coached. So a good bit of money, not nothing. And I'm opinionated about the best way to do it. I give a presentation that's like 45 minutes long on Fundraising 101. So I'll try to play a few of the hits for you right here and see if anything lands. Cut me off at any time if you want to go deeper on something. But one of the foundations for me is you need to start preparing to raise before you're raising. You need to be thinking about the very earliest days. Who do you know that has money? Who are potential investors? And not only do you need to know who they are, fire up a spreadsheet, write it down at very early moments of the company, but you should make yourself known to them. I don't think it's inappropriate. If there's an investor you're going to want to work with a year, 18 months, 2 years down the line, or maybe even a Series A, I don't think it's inappropriate to email that investor and be like, hey, this is what I'm working on. You don't know me, but I know you. I want you to invest in me one day, and you're going to be hearing from me. And that's it. And just kind of slowly make the market aware of what it is that you're doing. When you're raising the right way, it is a well-defined process. It has a start date, end date. You're running a funnel. And you need to be prepared as a CEO to take 3 to 6 months, 50 to 75% of your full-time effort, and have a lot of conversations. I think a healthy investor funnel usually has about 100 investors in it. And that means you're talking to all of them multiple times. And that's just a lot of meetings.
And is this kind of too like where when you think about, especially first-time founders probably don't know just how much effort it is, and like when you talk about kind of fundraising just sucks, because this a lot of that of where you're coming from that perspective is the time. You know what I mean? You want to be running your business, you want to be solving problems for customers, you want to be out building a great team or whatever, and you feel like you're kind of stuck in the muck raising money.
It's worse than that. I mean, it's a catch-22 because investors are going to say, "Hey, how's the business going?" And you're like, "It'd be going a lot better if I wasn't in all these investment meetings." So you have to find a way to keep the company moving forward, to show progress when you as the CEO and maybe one of only 2 or 3 or 5 people in the company are all of a sudden taken away from it. That is really hard. But investors are going to ask you tough questions, and this is going to seem like a joke. It is not a joke. Get ready for it. Here are the tough questions investors are going to ask you. You ready? Number 1, what does your company do? That seems like a joke. You should be able to answer that question. I cannot tell you, having talked to thousands of startups over the last decade, it is very difficult to describe with specificity what you do to a layperson. A question that I will often ask a new startup founder the first time I meet them is like, pretend I don't know anything about your industry or your startup. Pretend that I'm a 5th grader. Explain what your company does to me. And it's really hard to do well. Things like accelerators talk about pitching, talk about telling your story, talk about storytelling. It's such an important part of the business, and it's easy to be like, oh, and more pitch practice. But how you talk about your company matters. An investor asks you if you're raising. You want to trip a founder up that's never done it before? Be like, hey, you raising? Because here's what happens. You're an investor. You're asking them about whether or not they're raising. The founder looks at you and thinks, oh, this investor wants to know if I'm raising. I should say yes. If you want to see a lot of unintended consequences happen, if you're not raising money, tell an investor that you are raising money, because they're going to start asking you more questions like, oh, how much are you raising? And you're going to say something like, oh, I don't know, $1 million, maybe $2 million. Which is it? Is it $1 million or $2 million? You'll start to get ahead of your skis with this investor if you're not prepared to answer these questions. Then the list goes on. Hey, what's your valuation? And then you think as a startup founder, like, am I supposed to say? Am I not supposed to say? How am I supposed to talk about valuation? What do I do? What are you going to do with the money? I can tell you, having been in many fundraising meetings, the answers never feel good enough. What are you going to do with the money? Hire some people, run some ads, spend some money on dev. Coming up with unique answers that make you feel good about what you're going to do with the money is really hard. How big is this company going to be? If you're a startup founder, especially a first-time founder, saying big numbers out loud is hard. You find yourself in front of this investment professional, you look them in the eye and you say, I think it's going to be $1 billion company. And you have to say the word billion out loud. And not only that, but they have to believe you. That question can really trip founders up. So when I'm working with founders, what I'm trying to do on all of these questions, from what does your company do to are you raising to what's your valuation, I like to get them to the I'm so glad you asked stage. Because There's nothing more empowering than to be asked a difficult question and be like, oh, yeah, I'm so glad you asked. Here's what our valuation is. Or you can answer that question with confidence. And so preparing founders to answer questions with confidence is a big part of what I do. And I know we're going to talk about fundraising climate in a minute, but the fundraising climate does not matter if you are not prepared to raise money effectively. So one thing that we see with founders all the time is they say, oh, this climate's bad, I can't fundraise. And the problem is not the climate, it's that they're not running the process effectively. And so that's why talking about fundraising 101, talking about all of the things investors are going to say is so important.
It's a really, really important piece because, I'm guilty of it myself too. I think oftentimes the fundraising climate is like a really easy, on both sides of the table as an investor and as like a founder, but like it's an easy cop out almost as kind of a reason why the fundraising didn't go as expected, or, we couldn't raise money and things. The truth is, no matter what the climate is, the best companies will still get funded, and there's still like a best way to run a process. And that's really what it is kind of thinking about it as a process. Different founders, like your skill sets are going to vary wildly, but it's a sales process at the end of the day. It's like, to your point, you have a funnel, you have stages, you have stage gates of, are we at the term sheet level, or when are we at the partner pitch meeting or whatever? And there's very kind of particular stage gates and conversations. And I think it's helpful, just like when you're in a pipeline review meeting, when your VP of sales is grilling an AE on like, well, have you actually talked about price or not? And it's not a real deal unless we've talked about price and do they have the budget. In the same way with, I think, fundraising, have you had the conversation with X or have the conversation around valuation? You're not really in their funnel, until you have that conversation. I think just understanding that and kind of being pretty rigid around it is really, really important. One thing maybe to distill some of your thoughts of, we had a lot of companies in our portfolio out fundraising this year, and I'm sure you've talked to many, many more even, but thinking about last year, 2024, one of the big kind of discrepancies we started to see, one of the big trends within the industry broader is the tale of two cities in some way around kind of AI and non-AI companies. We can put some links in the show notes too, but like Carta data, looking at startup fundraising kind of benchmarks across the board from seed, Series A, Series B, there's an incredible difference between an AI company and a non-AI company, and kind of what is the 50th percentile and things like that from a valuation and cash raise perspective. I'll kind of quote some of this from CB Insights, recently released their Q4 in 2024 as a whole kind of venture wrap-up report that we'll also link to, but their synopsis was AI eating VC, and the AI represented 37% of all venture funding in 2024 in dollars and 17% of all deals, both all-time highs, which is not necessarily a surprise, but then even particularly the top 5 venture deals of the year, 4 of them closed even in Q4 2024, which is really kind of wild, which were all AI deals, OpenAI, Databricks, X.AI, Anthropic. But I think we're seeing, both in terms of valuation, but also just in dollars, like a major shift towards AI. And so I think what we're also seeing now is every founder probably scramble for like, how do I tell, what's my AI story from an investment perspective? Like when I'm figuring out though, what do we do? How does AI need to kind of show up there? So maybe just how are you thinking about, what does it really mean to be an AI company? How should founders be thinking about their AI story in their pitch, and whether, should they lean in, should they lean out, and how do you make that decision as you're putting together the story in particular even?
Yeah, I think the first thing I would say is, even in a more difficult fundraising environment, from the last 2 years, an absolute ton of AI funding is happening. So, timing is everything, and the industry that you're in matters. And so for companies that were really building the foundations of AI over the last few years, they were able to raise lots and lots of money at massive valuations. I have not seen, maybe blockchain, but this is worse, a scenario where it went from what's generative AI again, to every single pitch I hear is AI for this, AI for that, our company's this.ai. I don't hear a pitch right now of a startup that does not have an AI component, which is great. You should have AI baked into your software, but your storytelling around this really matters. And in understanding where you fit on the AI spectrum and what the investors are hearing when you talk about AI really matters. Because look, at the end of the day, to go back to Fundraising 101, investors at these stages, at the very earliest stages, are betting on the founder and they're betting on the market. And so it's almost like it matters, but the answers to your questions are less important to how you deliver the answers to your questions, because you're being assessed as a founder. But, back to the AI question, how can an investor sniff out whether you're a real AI company or not? Certainly if what you're building is core to AI, if you're an infrastructure company, you pointed out, 37% of funding last year was for AI. And I think all of the top 5 deals or 4 of the top 5 deals were AI infrastructure companies. So if you're building the guts of AI from the algorithms that make it run to the servers that it runs on, you're in a pretty promising spot right now. I would ask myself, was my business possible before AI? And if the answer is like, yeah, I could have totally done this business before AI existed, then it probably isn't an AI company. And I can certainly tell you that if the extent of your AI is that you're integrated with the ChatGPT API and you're just like cleaning up some of your text on some of your pages through the calls you're making to them, you're not an AI company. And overselling the extent to which your AI can really hurt you in an investment meeting. And you need to be careful about how you do that storytelling.
How would you advise a founder around when they get the AI questions, or how do they not feel left out, or do they try to wedge it in still, or do they still have a slide in the appendix that's like, and here's our AI strategy, or, the kind of like, should they anticipate that question, or like, how are you thinking from that perspective if a company is not, I would say like a native AI component to it even?
Yeah, look, it's the old-fashioned answer, but maybe tell the truth.
Yeah.
Certainly you will get the question, what's your AI strategy? How does AI bake into what you're doing? And it's hard in this environment to imagine startups that don't have some, whether even if it is a ChatGPT integration or whatever it is, some low level of AI baked in that's appropriate in practically every scenario now. But how you tell the story about how AI fits into what you're doing, I think, is the magic. Investors are going to suss out really quickly whether you are puffing your chest out too much or not, and that can get you in trouble really fast. So it's a tough line. It's a tough line to toe, but tell the truth. Maybe that's a little simplistic, but tell the truth.
Yeah, simplistic, but yeah, sometimes needs to be reiterated of, the worst thing that happen is just getting caught up in the hype and backtracking your words, or trying to be something you're not. Another trend, I feel like, especially, we're sitting here at the beginning of 2025, 2024, venture capital dollars slightly higher than 2023. 2022 was one of like the worst years, at least in the last decade. 24, though, we're kind of back to pre-COVID levels. There's an insane, when you look at 2020 and 2021, the amount of venture dollars that were pouring in, it caused for some really wild discrepancies in the data, which is interesting. And I think we're kind of back to like the trend line prior. But maybe broadly, one of the big themes, and I think because of this anomaly of quite a lot of companies in 20 and 21 raising money, so it was a much harder environment in 22. A lot of the conversation shifted more towards profitability, towards cash efficiency, towards revenue per head, more like, I would say, mainstream kind of business metrics, but also, do you have a good business on your hands? Does the model make sense? Both last year and kind of looking into next year, like, how do you think some of those ideas and concepts will continue into the new year around companies? Hey, we raised this amount and we're going to be profitable over the next year. Like, that used to be kind of blasphemy almost. Like if you were talking to a venture investor, like, no, we want to keep writing checks for the next 10 years in your company, where it was not looked down upon quite as much over the last, call it 24 months. And do you think we'll see the same thing kind of into the next year? And what's this balance between cash efficiency and what founders are raising, over raising, some of those kinds of thoughts in your mind?
Well, first, I would point out that cash efficiency is never a bad idea. I grew up in small town Kansas, and the first company that I ever started out of law school, I had no frame of reference for fundraising. I didn't know what high growth startups were. I was just an entrepreneurial person that assumed that if I went and got some customers and revenue, then I might have a company on my hands, which is not a bad way to think about it, by the way. You said something earlier that I say a lot, which is good companies get funded. And so if you're out there on the circuit, you need to have a calculation in your head. If you talk to a VC, what percentage, where do I have to fit? Do I have to be one of the top 10% of companies this VC has talked to have a chance at getting funded, top 5%? If things are super frothy, maybe you can be in the top 25%. But still, regardless of the environment, most companies don't get funded and great companies get funded. Still, in difficult environments, you need to be better. You need to tell a better story. You need to understand how to run a tighter fundraising process. We see a lot of companies that just kind of find themselves perpetually raising money and never doing it very well, and that is not the place that you want to find yourself. But look, the 2022 was hard. The fundraising environment was difficult. It hasn't recovered, I don't think yet to, well, I don't know about pre-COVID levels. I mean, during COVID, we all thought the fundraising was going to be bad and the money was flowing. And there are companies that raised huge amounts of money during COVID at big valuations. And maybe they are being capital efficient, maybe they're not, but they just aren't going to get the valuation they got during COVID for this next round of funding. And they're not going to get as much money as they would have liked. And if they didn't manage their COVID money very well, they're going to be in real trouble. And in some cases, there's some businesses that don't deserve to be in as much trouble as they're going to be in, but are, potentially going to fail. And that's really hard. But at the end of the day, look, great companies get funded. And if you don't want to worry about any of this fundraising talk, just go out and get some customers and revenue. Never a bad idea in my estimation.
The best fundraising is coming from customer contracts, right?
Amen.
Maybe it's an interesting track to also go down. Like, how are you also advising our founders when it comes on that front of, should we go out and raise more funding, or like, should we double down on let's fundraise through customer contracts? And like, how do they balance some of that? And what do you specifically, and like, we work with such early stage companies primarily as well that are idea stage, pre-idea stage. So in that kind of realm and that area of their life, kind of how are you advising a lot of our founders?
Well, high off innovation is unique. If the two of us, Drew, if you and I go quit our jobs right now and start a company, there isn't any funding there, and we're just, presumably we own the whole thing, we're off to the races. Any company that launches out of high off innovation has some initial funding intact. And so any of the founders that, start a company through us are managing a non-trivial amount of money at the beginning. But what that means is that they've already done some fundraising by virtue of launching a company with us. And everyone thinks if I raise this much money, I need to go raise twice that the next time or 3 times that the next time. And so our company is getting to product market fit, to getting to revenue, to getting to first revenue, to signing pilot customers up, to demonstrating their worth in the market is essential. And so what do we tell our companies? Get to revenue as fast as possible. If you don't have to fundraise again, great. Now, that being said, all but one, we have 24 portfolio companies, and we probably had 10 in market raising in the second half of last year. And I believe all of them raised. Maybe one of them is still working on it. But we had a lot of success raising money last year. And that comes on the heels of us telling companies, go be profitable. You don't need to raise money. So maybe if you focus on the right thing, then the fundraising just comes. But yeah, never wrong to go talk to customers.
Yeah, the best story is a whole slew of, customers that are just clamoring to get more and more of your product. You know what I mean? Like, that's you can't tell a better story than that. And back to the 3 reasons why you fundraise, and like the number 3 of like, you don't need it, but the market is throwing the money at you. There's no better way to not need it than to be showing customer traction, to be cost efficient. That's an attractive business that the market will be throwing it at you.
It's all engagement for me. If I have my investor hat on, I'm talking to early stage companies that say they have any number of customers or revenue. All I care about is the engagement of their early customers. There are a lot of definitions of product market fit. My favorite is if you take your thing away from someone, they're going to be ticked off. And that's hard to get there. We all have a certain number of websites we visit every day and a certain number of apps on our phone that we refer to every day. And breaking into that is practically impossible. And breaking into that to a point where you rely on that as essential to your day-to-day personal or business life, so hard. And so what does the engagement look like? Who's using your product? And if you took that product away from that person, are they going to be upset? Those are things I look for really early.
Any last bits of advice or feedback to founders out there that are either about to embark on opening up a fundraiser on a fundraising journey here, or are in the middle of it right now?
It's, as much as we say fundraising sucks, I would say approach it with some amount of optimism. There is fundraising to be had out there. There are funds raise money too. And then they have to deploy that capital. You as a startup do not have to go raise money. You can just become profitable. But VCs that go raise big funds need to deploy that capital. And so there's money to be had. There's this idea that founders have that VCs are out to get them, that they're predatory. I'm sure that's true in some cases, but I generally believe that this is an industry of well-intentioned people that want to see new innovations come to market. And, treat your VCs how you would want to be treated. Treat your investors the way you wanted to be treated. Attack it with optimism. Know it's going to take some real time. And focus on the actual process, and you'll have a better chance of being successful.
Yeah, I love that advice. Well, thanks, Nate, for joining me here on this episode, and hopefully we'll have you back in another capacity if we continue doing the podcast in the future. So